Hey guys, and welcome to another week ahead video. Now in this week our focus will turn to a couple of interesting events we have lined up. We have earnings season continuing, very big names there: Apple, Amazon, Facebook, Google, Alphabet. Couple of big names we need to watch out for. Can definitely spark some risk on risk of flows. Also US Q2 GDP numbers on Thursday, as well as initial jobless claims, will be important. We have the FOMC coming up on Wednesday. The biggest focus from all of these, however, will arguably turn towards the US stimulus bill that's currently in negotiations between different political parties. Obviously, that bill very, very important from a US economic recovery point of view. So any major setbacks there or breakthroughs can be really influential for risk flow. So join me now to the video to see how we're preparing for this week's event and hopefully how we can trade them in this upcoming week as well. So following on from last week's report, the question of whether the current risk rally can continue is still up for debate. Even though equity markets did print fresh post-COVID highs this week, we did see some downside on Thursday and Friday as well, with negative catalysts coming back into play like US-China tensions and a flattening of some very important high-frequency recovery data. Good example of this was the recent New York Fed weekly economic index that started to slow down and turn lower, pointing to a possible slowdown of that current recovery. And small business, which is a crucial part of any economy, there's a very useful website called tracktherecovery.org that basically showed the number of small businesses open decreased by 14% compared to January 2020. Now, there was also growing concerns, of course, about the looming deadlines for the previous stimulus measures in the US. These fears were somewhat exacerbated by the recent initial jobless claims data, which showed its first increase since March. And the most likely catalyst for this, of course, was the recent reinstatement of lockdown restrictions in key US states. Now, according to Nordea Investment Bank, states corresponding to a total of 84% of US GDP have thus faced increased restriction measures during July, with almost no states in the midst of opening up more, and this should have a negative lagging effect on the macro momentum. Now, we also saw a fresh dose, of course, of geopolitical tensions as the US ordered China to close its consulate in Houston, and China retaliated by ordering the US to close its consulate in Chengdu. Now, with the US elections around the corner, we definitely should strap ourselves in for more actions like these in the weeks ahead. Another focus point, as we said, was the looming deadline of US government stimulus programs. And even though Treasury Secretary Mnuchin did confirm that another 1,200 stimulus check is on the cards in August, the big question comes down to the unemployment benefits or payments. Now, if the unemployment benefits come to an abrupt end next week, end of July, that poses a fiscal cliff edge for US consumers and the economy, and this will probably be the main market focus in the week ahead, but we'll get back to that in a couple of seconds. So how has all of this affected the risk rally? Not very much, to be completely honest. Yes, we've seen some downside at the end of the week, but given the recent size of that recent rally, a correction was arguably way overdue anyway. Whether we continue lower this week or whether value buyers step in somewhere at these levels will largely come down to that US fiscal policy and whether political parties can agree on a package before the current ones expire. Another thing to keep in mind is even though the high frequency data has been flattening, a further deterioration in hard data might cause some short-term downside risk for equities, but as long as markets think that central banks and governments will have their back and basically step in with further stimulus, the downside might be limited, so always keep that in mind. The focus in the week ahead will fall on four areas, namely US fiscal policy, US-China tensions, US earnings and GDP data, and then the upcoming FOMC meeting. Starting with fiscal policy, the biggest focus in the week ahead will come from any major setbacks or breakthroughs with the current US stimulus measures. Now, some progress has already been made with regards to another 1,200 stimulus check, but the big question for markets will fall on the unemployment benefits and the eviction moratorium for federally insured multifamily homes. Now, according to the Nordea chart above, we can see the saving grace that sparked most of the jump in recent consumer spending has been the unemployment benefits. Thus, there is a growing fear that the US will face a double dip or fiscal cliff edge if politicians doesn't pass a big enough follow-up rescue package, which includes further unemployment benefits as well as support for local and state governments. So far, there's been reports that the employment benefits will be significantly lower. The current is, of course, $600 per week, and some sources like the New York Times citing a possibility of a $200 per week payment. So that's drastically lower than they're getting right now. According to the Economic Policy Institute, or EPI, there are currently 30 million people claiming these benefits. Furthermore, they added that the spending generated by that $600 benefit per week is supporting close to 5 million jobs right now. And one reason why the government has been reluctant to continue the $600 benefit is because it might incentivize people to just stay at home. But on this point, EPI also explained that there are 14 million more unemployed workers than there are job openings right now, which means that those 14 million people won't be incentivized to find a job if there aren't any jobs available for them. And all this just re-emphasizes the risk to the economy and the recovery if these benefits are not maintained. Second point, US-China tensions. US elections are a little more than 3 months away. What does this mean for you and me as traders? It means we should expect further negative rhetoric and retaliatory actions between the US and China in the run-up to the elections. Some analysts argue that the tough stance on China, especially after the virus, will be a key driver of political posturing in the coming months, which means we need to strap in for more negative comments, negative tweets, reports and actions between these two sides. The market's big question on this front is whether increased tensions puts the phase 1 deal at risk, and if it does, things could get a little messy on the risk front. Turning to earnings season, a big week for earnings coming up. We've got names like Amazon, Facebook, Apple, Google, Alphabet, Ford, McDonald's, GM, Boeing, lots of big names. So far, earnings expectations being so super low. Over 80% of companies that has already reported has already surprised to the upside. So for that reason, as we mentioned over the last 2 weeks as well, we maintain the view that there is more upside risk to earnings than downside risk given that low bar. And the recent outperformance in the Nasdaq 100 means a lot of focus will be on forward guidance for the key names like Amazon, like Apple, Facebook, etc. Any big disappointments or big surprises for these names can cause significant moves in indices like the S&P and the Nasdaq, given their composition. Then turning to Q2 GDP data for the US and EU now. Yes, these have been long-awaited numbers and they are highly anticipated, but they might only be useful from a sensationalist headline point of view. The market impact might be more limited because GDP data is backward-looking and the range of these expectations are just massive. Right now, markets expect a negative 34% contraction with a minimum expectation of negative 40 and a maximum expectation of negative 24. So, markets should not be too surprised as long as we stay in that range of estimates. And given the low hurdle of expectations, a much better than expected print will arguably have a much bigger impact due to the continued overly optimistic hopes of a V-shaped recovery. So as long as we are within that range, it might have more of a short-lived reaction. However, coming closer to those outer edges, coming closer to that minimum and closer to that maximum, will definitely have some reaction. So one to keep on the radar. Then FOMC. Markets aren't expecting a lot from the FOMC this week. According to Scotiabank, the Fed is basically in a wait-and-see mode right now, having bought themselves some time to evaluate the impact of the current policies, especially before the important September meeting, which will include things like the latest summary of economic projections. Now, in the prior meeting, Fed Chair Powell explained that they are in a learning mode right now, and to appease markets about their current patience towards that ultra-easing bias, he said that the Fed isn't even thinking about raising rates. Now, there are some expectations among a few analysts who think the Fed might opt for strengthening their forward guidance at this meeting to basically ensure their commitment to easier policy, especially looking towards the medium term. Now, so far, the recent speeches by Fed members seems that outcome-based forward guidance is the preferred way above something like calendar-based or time-based guidance. And Nordea Investment Bank expects the Fed to implement average inflation targeting as well as yield curve control sometime within the coming months, possibly as soon as September. Now, an addition like ATI or average inflation targeting combined with yield curve control should be a slam dunk for equities, as it will mean that not even the prospect of inflation rising above 2% will sway the Fed from the ultra accommodative stance, at least for now. However, the Fed is still in the process of completing their strategic review, which means the markets meeting will probably be a little bit of a non-event for markets this week. Then looking at possible sentiment drivers, starting with the hawkish ones, starting with fiscal policy, approval of a bill will be a sigh of relief for markets this week, and a bigger than expected benefit for the unemployed would be an additional tailwind. And approval of the bill will probably see that knee-jerk reaction in a positive sense, but watch out for a possible reversal if the bill is passed, but includes a much smaller than anticipated benefit, especially for the unemployed. Looking at earnings, another possible positive catalyst this week is Q2 earnings for the big names like Apple, Amazon, Facebook, Google, Alphabet, just to name a few. And with the hurdle so low for Q2 performance, we might see more better than expected prints coming out this week and could see additional upside if forward guidance is less bleak than currently anticipated. FOMC, markets are not expecting the Fed to make any changes at this meeting, especially with things like ATI and yield curve control only expected from September. However, if the Fed dismisses the recent downside in that high frequency data and seems more optimistic about the road ahead, that can see some risk on flows as well. And if the Fed adopts stronger forward guidance at this meeting, that will once again just show their willingness to do whatever it takes and could see another leg high in equities as well, maybe even all-time highs. And before you say never, remember, when it comes to the markets, never say never. Looking at vaccine news, as always, be ready to take advantage of any positive drug and vaccine related news. There have been some of the best short-term trading opportunities recently. Looking at the dovish sentiment shifts, again, fiscal policy, the biggest news this week will resolve around that US stimulus discussions. With a US administration that is very concerned about equity prices, I'm sure there is a lot of urgency to reach an agreement this week, and that is my baseline expectation for the week ahead. Now, a bigger focus then could be the size of the bill and the size of payments, and if markets are disappointed by either of those, that can still see some risk of flows, even if we do get a bill passed. Looking at US-China tensions is another one. The recent consulate spat might only be the beginning for these two, with US elections around the corner. Any meaningful retaliation between the two sides can create some risk of flows this week to take advantage of. However, some analysts argue that markets can see through the heightened tensions as long as the phase one deal is intact. Thus, it'll be best to take advantage of negative developments as soon as possible, as markets might shake these things off fairly quickly, as was the case at the beginning of this week as well. FOMC, after the June meeting, we saw equity markets take a beating as they felt the Fed painted a very bleak picture of the economy, especially of the recovery, due to the wave of second virus numbers that just started to tick up in June, if you guys remember. So this time around, markets have grown accustomed to that second wave fears, which might not have the same type of impact. However, if the Fed comes across more dovish than expected due to that recent slew of high frequency data pointing to a flattening of the recovery, that could spark some downside. But, and this is a big but, remember that a slow recovery should also spark more hopes for more accommodation. So just be careful of that one. Also on the dovish front will be earnings news. Of course, we have those big names coming out. If any of these names, these big names, come out disappointing across the board, also giving very bleak forward guidance, that can also be a negative catalyst for the week ahead. So definitely one to watch. Even though there are key data points like Q2 GDP this week, we think the main driver will be politics in the week ahead, with things like US-China tensions and of course that fiscal bill. So our main focus will stay on risk sentiment trading opportunities. Now, with the biggest focus tilting to risk flows, we will look to take advantage of risk sentiment shifts by focusing attention on things like equities like the S&P 500, focusing on the high beta currencies like the Aussie, the Kiwi, the CAD, and look to trade those against safe haven assets like the Japanese yen, the Swiss franc, also looking to trade things like gold and US government bonds. Now, the dollar will be an important mover this week as it has recently lost some of its safe haven appeal as the EU recovery looks to be miles ahead of the US. Now, apart from that, ING Investment Bank has noted that international trade has started to pick up recently, albeit way off pre-virus levels, which should be another negative catalyst for US dollar due to liquidity. However, just keep in mind, Nordea Investment Bank has cautioned about further dollar downside from here, saying they also maintain a medium-term downside bias for the dollar like we do, but there are signs that we might be due for a correction sometime soon. And they explained that markets have been wrong-footed 4 times out of the last 5 times since 2012, when the US dollar short positioning was as stretched as it is now. Now, having reached a key support area for the dollar index in the week, there is some scope from a pullback point of view, from a purely technical view as well. So just keep that in mind. However, as we noted, as long as the hopes for a quick global recovery is alive, as long as international trade keeps increasing, the expectation for a lower dollar will continue to rise. But just keep the above comments in mind when looking towards the dollar in the week ahead. Now, as our focus stays on overall risk sentiment, do remember to trade risk sentiment shifts not in a vacuum. Always consider the underlying macro themes and drivers for the individual assets as well. Now, in this type of market environment, guys, it can be quite tricky to trade into any upcoming events. So what we prefer to do is wait for sentiment shifts to occur and then trade out of those events. In this type of market environment, it's also wise not to aim for too ambitious targets. Keep those shorter targets in mind, like the S1, the R1 pivots, your ADR high and lows, and also obviously incorporating your other key technical levels like your support and resistance and psychological price levels for the highest probability entries and exits.